Alright, so greetings traders. This is going to be a session that brings more clarity to tab 29 or some comments about some of the things I've seen going on with trading tab 29 as we roll it out. And I think it'll bring some important information. Now, we're getting to a point in our trading careers where it's not that things get complex, but you have to start stringing stuff together. So going all the way back to Lori's original comments about Lori's Law, where we're talking about a trading, the trading reality, the trading realm becomes something in which we have to be able to recall the knowledge we already have. So that can be a combination of local emphasis, current emphasis, current focus, RIS, misunderstanding, bad transmission, any number of things that could bring confusion. So just want to clarify a few things. The first thing I want to talk about, and we've mentioned this many times in just the multi-wave world, but even more so true as we've evolved over the last few years, and now we have tab 29 out here. And that is, what we really have is not a trading model. We have the science of price movement. So we focus on this science, and we look for ways to exploit price movement with the ability we have to analyze it with the indicators that we have that kind of function in this harmonic wave convergence world that measure trend strength and trend exhaustion. And in a multiple time frame analysis way, gives us insight to convergences and retrace extremes and things like that. As with all science, it's not 100%. Well, actually, it probably is 100%. It's just we maybe not have all the information we see to have that clear image that 100% would give us. But the bottom line is the thing that's been true from multi-wave now through Shredder, from Shredder within using multi-wave now through tab 29, is that not being a system but being a science, we have many ways to deploy our ability to exploit profit out of this. And none of them necessarily are more right or more correct or better than another, as it really is measured against your lifestyle and what it is you're trying to do. So it is a transition you have to take from the old paradigm to the new paradigm. In the old paradigm, when you have a system, you have confines around the parameters. You have very specific parameters, and this is how you do it, and you do this on the 15-minute chart with this and that and blah, blah, blah. And the system dictates your lifestyle. You adjust your lifestyle around that trading system. When you learn the science of price movement with harmonic wave convergence, and you learn how to exploit and pull profit out from the movement of price against the multiple time frame environment, you have flipped the scenario. You have the ability to let your lifestyle rule and determine what it is you want to trade. So Mark versus Isaac versus Kevin versus Rudy versus Ross versus Tim, may have different lifestyle requirements, different things they're trying to achieve, different emphasis on the Forex, and so you may not be trading the same thing. And that's a cool thing, but then it lends itself to, you have to remember that, and you can't get caught up like you would in the old paradigm where, what are you doing in this trade, what are you doing in that trade, as if there's a way to do it. And everybody needs to be moving towards that way to do it. First, in the training that we did for tab 29, when we got to money management, you notice that was a very small, this is 15 minutes on money management. Why so little time? Because in the reality, the system, the math, the way the science works, the way we exploit profit out of it, the way we can protect our mental game is all established for us by the 310 system. The money management is just something we throw on top of that. The money management is something to keep us disciplined and consistent. And as I said there, and of course you're not going to hear this from any other system, the money management you use doesn't matter. As long as you treat the same money management, as long as you use the same money management system consistently throughout all your trades that are like that you're applying it to in those same circumstances. In the end, with the volume of trades, if we go a year and there's 500 trades or 700 trades, whatever there is, guess what? Everybody's going to be within 3, 4, 5% of each other in terms of the number of pips they got. So to look at trader 1 and to see trader 2 chasing him down, what are you doing for money management? Hey, it's okay to see and to explore, but there's no right or wrong to it. There's not one way of approaching money management, and we're talking about essentially how we're managing the trade once we're in it. We all have the same money management in terms of getting into the trade. We all have the same money management philosophies as we start the trade. Conserve and protect. Let my equity ball be the same or bigger at the end of the day. 3 pip, 2% to a 10 pip stop loss, 1 pip below harmonic wave convergence, 1 pip below a retrace extreme. We have certain rules about entries. On a fan retrace, that's greater than 9, 10 pips. In a true retrace against the snake or a retrace, we can take that buy into the sell or sell into the buy as long as we're committed to take the second one in case we get stopped out. So we do have some what would appear like system rules for trades. But once you're in that trade, the money management's up to you. And as long as you do the same thing. And you know what? If there are going to be differences, if you're going to be within 3 or 4%, what that means is in some trades, some traders are going to make more profit than others do. And in other trades, those other people are going to make more profit than the initial traders might have. But we don't go trade to trade to trade to trade. We look at the volume of trades. That being said, because different ways of using money management once you're in a trade for a system or an environment, a science that lets us trade different time periods, for a science that lets us build a trading environment, a trading plan around our lifestyle instead of dictating our lifestyle, there's going to be flexibility. There's going to be differences in how traders pursue this. Doesn't mean we can all be different, out there with shotguns doing different things. It just means that's the way it is. See my charts refreshing. I had to reboot my computer about 10 minutes before I started. I wasn't sure I was going to get in here, to be honest. I was going to a website and I misspelled the name. I missed one of the vowels on the inside of the name. And sure enough, somebody grabbed the domain for the misspelled name of this company and had a virus out there. So as soon as I landed on it, I got the attack. And normally I could go into the task manager and delete the latest Chrome page that was added and all as well. But this time, whatever was there was strong enough to block my mouse and stop my mouse movement and whatnot. So I had to do a total hard shutdown. And so things just came up literally. Charts were starting to come back up a minute before I booted up. Yeah, Tim says, yeah, Tim. Yeah, that's what Dallas said too. Dallas is here. He goes, yeah, quit going to those websites, Dad. Now, this is like the third time this has happened in about 2 weeks. Just a mistyped website and somebody has already grabbed that, smart enough to know people are mistyping. They go to the keyboard and pick one letter over on each side and buy domains. And it's a crazy world we live in. Very frustrating to have to go through all that process, lose data that was there. Anyway, so we have a system that lets us try, we have a science That lets us create various systems based on, you know, lifestyle objectives, financial objectives, you know, how much we want to trade, how much we don't want to trade, how aggressive we want to be in our capital gain, you know, what time frame we might have a flavor for, etc. So there's no solid, you know, this is how you do it. So we have some guidelines for various time frames, and then within the time frames, there's just no way of saying this is how to do it. Now, what that really means is there are degrees of, I don't want to say success, because if you're 1 degree less of success than something else, it makes it sound like it's not successful, and that's not to say that. But there are degrees, I guess, of increased profitability depending on how you trade this, but with trade-offs. And so as a coach in a group, one of the things I have to be careful of are the various demands the various traders have, be it lifestyles, be it education, be it past trading experience, be it, you know, what lifestyle they're trying to accommodate with our system, etc. Big continuum. I can go in here and say this is the optimum way to trade this system, and only roll it out as if that's the system. Don't show the whole thing. Don't show the science behind it. Don't give people flexibility. Just say, here it is, step 1, step 2, step 3, step 4. I can do that. I can give an optimal view of trading TAB29 at the 30-minute level, at the 10-minute level. But what that's going to do is take out 50-70% of the traders, because they might not be able to trade it in an optimum way, regardless if that means what I'm doing technically on the charts, you know, money management, time I can spend with it, etc. So understand there's no perfect way of doing it. It's optimal only to you as an individual, only to you as your lifestyle goals would demand your trading support you. So I hope that makes sense. So I talked the other day about, or last week, about, for me, based on my way of trading, 1, what I want to do, and 2, what my schedule and the way my schedule flows allows me to do. You know, I prefer to approach TAB29 with assistance in my view of what's going on in price and how to exploit my profit from it. In saying that, what TAB29 really is a confirmation, a go-to of everything else that's on your chart. It's not the system itself. And a lot of traders go backwards with this, and I know they go backwards with it because I see what they do. They look at TAB29 and they base their trades on that. And, you know, that's not the way I'm trying to teach it. I'm trying to teach it is the last confirmation. It's a darn good one. But it's the last confirmation before taking a trade. And at that, depending on what other external variables are there, sometimes you don't even need it. The other variables can be so strong. An example would be a well-proven traditional pitchfork with 5 to the pip. You get somebody in the audience that likes me to say, to the pip. 5 to the pip touches with big, long scouter wicks. You know, 4, 5, 6, 7 pip wicks. 5 times in a row. Well, not in a row, but, you know, spaced apart. And now I'm coming up on that pitchfork parallel the 6th time. As it hits it and it pulls away 2 pips, I am taking that trade. I've been around pitchforks long enough. I'm taking that trade. I don't even need to look at multi-waiver TAB29. In that instance, the use of the pitchfork to help me see where market movement is, the understanding of the pitchfork via Andrew's observation, in that particular instance and circumstance of the pitchfork, I can do that. And I do that with the same things we talked about last week, high probability and high reward to risk. And so it's a trade I'll take anytime. You know, I have traders that sometimes confuse me. We have traders who were good pitchfork traders. They were taking live trades on pitchfork bounces, 2 pips of pullback in the trade. And they were winning higher percentages, much higher percentages than they lost. And when they won, you know, the risk reward was much higher than the 3 to 4 pip loss they had on a bad entry. So not only were the winning percentages much higher, but again, the risk reward was high. And now, because of the, you know, the interpretation of TAB29, they're not taking as many pitchfork trades because they don't have the confirmations. And it's like, look, I'm proud of TAB29. I'm proud of what it does. I think it's a really hot system. But I'm also not going to be so arrogant to say, if you had something that was working before TAB29 and it was working consistently with high percentage and high profit, why would you let TAB29 take away from that? Why would you let TAB29, you know, give you trades that you weren't taking before or stop ones that you were taking before that was successful? I personally don't get that as a trader or a coach. Okay? So we have to be careful as we incorporate new learning, new technology, new ways of looking at the charts. And it should be bringing improvements. If some area of your trading was already strong, you know, and you get an iffy confirmation from TAB29, I'd just stick with what was already working for you. Again, I'm not downplaying the significance of TAB29. I'm just, let's be real. Let's be transparent. Yeah, it's another arrow in your quiver. You have to understand when there's times where you have to be firm with yourself and discipline on what TAB29 is and how to use it, and other, you know, and well, that's it, what it is and how to use it. There are times you have to be very literal with it because of the circumstances, and there are other times you can be very liberal with it because of other justifications that you have on the chart. So I give that all as background information. And so when we take off where we are now, you know, a week, 2 weeks out of the class, we should go through a rapid, let's get a bunch of trades out of the way, and let's get the stuff we're going to do that we need to be brought back in alignment with so we can get back to trading. In other words, let's get through the stuff that is, oh gee, this shouldn't be done. Why did I do this? This is the wrong thing they'll be focusing on. Let's get that, because those are easy fixes. Let's get those out of the way so we're left with just the stuff that works, the way the funnel and the flow of a trader should always work. Let's work on flushing out the things that don't work with our trading, with our quote-unquote system, so we can be left with the stuff that does work. I said for me last week, I prefer TAB29 when married to pitchforks and trend lines. Now, again, that's not saying that's a better way of trading it. I'm saying that's a better way of trading it for Steve, based on the time I have, based on what was already my previous trading style, which was a trap setter. Because I can continue that kind of mindset with pitchforks and I can continue that kind of mindset and strategy, tactic, you know, with pitchforks and trend lines and using, you know, pitchfork alerts or diagonal line alerts in order to notify me when price is getting near a trend line. I like that. I like to not have to be 100% focused on the charts until it's actually time to take a trade. Why do I do that? Because I've noticed I'm the kind of trader over many years of trading, it's easy for me to get chart addicted and burn out in a given day. I want to do that. I want to be able to trade from 5 o'clock in the morning till midnight, but not all that time, in spurts that I want to put in. Because there's good price movement and a variety of price movement, sometimes some consistency, sometimes surprises, when I have those opportunities based on what else I got going on in my life. So for me, trend lines work. So the analogy I gave out yesterday to a trader, we know, well, for Americans, you know this. For the foreigners, I'll explain it if you're not familiar with our currency. You know, we have these copper pennies, 1 cent, 1/100th of a dollar of the USD. And we have quarters, silver, well, they used to be silver. They're all, you know, mixtures now. A 25-cent piece, a quarter, 1/4 of a dollar, a quarter of a dollar, 25 cents. So if I'm out in a parking lot and some dump truck has come along, a literal just thousands, millions of coins, but there's nothing but pennies and quarters in that dump truck's haul. And he opens that tailgate and he starts to lift the hydraulics and he starts angling that tailgate up, or the dump bed up, and he starts driving off, leaving a trail of coins. And he drives around the parking lot until that truck's empty. We all have options on how we want to pursue that. There are going to be some people that just want to reach down and pick up every coin they can, whatever's within their reach. We got some that are strictly going to focus on one or the other from various time to time. See, if there's 10 times in this particular dump, if there's 10 times as many pennies as quarters, I'm the guy that's just going to focus on picking up quarters. I'm not going to reach down every time there's a penny to be picked up, because I know at the end of a given day, that number of times reaching down, that number of times squatting down, you go do 500 squats in a day, even if no weight on it, just your body weight. You bend over 500 times in a day, you know, when you're not 20 years old anymore. And I know what your back's going to feel like. So for me, I choose to pick up the quarters and ignore the pennies. Yeah, there's 10 times more pennies. Yeah, I'm going to see 10 times more of them on the ground. But I'm going to pick up the quarters. If Steve has an allotted amount of time to deal with, I'm picking up the quarters. I don't care that there's 10 times more pennies, because every time I pick up 10 pennies and I pick up 1 quarter, I still making 2.5 times the profit. This is a little bit of throwing risk-reward into the mix of what we do. It doesn't mean that picking up pennies isn't a good thing. It's just Steve says, based on my back, based on, you know, I don't want to be sore tomorrow because I've got a hike tomorrow, and I don't want sore thighs and quads from doing, you know, 500 squats today, picking up so many pennies. And at the end of the day, I can make as much, if not more money, by just going after the quarters. It doesn't mean the system is all about picking up quarters. It's about making pips. It's about getting coinage. It's just I've tailored what's available to me to be optimal for me and what I want. So if the only TAB29 trades I'm going to take are going to be those with very accurate trend lines, and we'll get on that in a minute, but very accurate trend lines as my trading criteria, it doesn't mean TAB29 doesn't work elsewhere. It doesn't mean that in only going for trades with trend lines or pitchforks that I won't miss some good trades. It just means that the way I want to approach it, or the way I can approach it, works through the math, works through my lifestyle, works through the volume and frequency of time I have on the charts in my day to still deliver what I want out of it. So be sure you understand what it is we have. We have a science, and we've evolved the indicators of measuring that science. But it can still be deployed many different ways by many different traders depending on what they need out of it. Okay, so it does make it a little hard to get the the learning curve up, because everybody's looking to do cookie cutter approach. Hey, this is what I do. This is what I do. This is what I do. Give me the 17 steps. When there's decision trees, it's not subjective. It's just their decision trees. Now, I talked about opportunity of trades. I talked about lifestyle. What else is there? What else would determine, if I work closely with two traders, let's say, 6 months, trader 1 and trader 2, why might I recommend, and they both have the same size accounts, and they both kind of have the same size kind of dreams, and they both have essentially maybe, in this freak example, both the same kind of accessibility to trading in charts, and their desires match. Why would I show them kind of two different things? What would be one reason I would show them two different things? This is time for participation, interactivity. Yep. So things like personality, things like mindset, things like mental outlook. And simply could be something just what works for them. Right. But the mind game is so important, guys. See, I said this yesterday, so a little repeat to a few people. Well, to one maybe. We have this thing with our money management. You go to the money management module, and there's some top-down thinking in how that was presented. We have a big picture money management. Big picture money management. Conserve, and protect. Because what this is talking about is exactly to counter a lot of what you see with some of these young millennials. Nothing against millennials, because we have some very successful ones too, but just in a larger group. Some of these young millennials who are, putting 5%, 10% into their trades. I posted an example a week or two ago, well, maybe 2 or 3 weeks ago, of the guy that, a couple of people were picking on a guy because he lost $29,000 in 3 days. And one of the guys commented on it, yeah, that's pretty bad. I can relate. It happened to me. I lost $25,000 when I first started. See, there was no conserve and protect thinking in their money management. Now, it doesn't make them bad traders. They might have not had exposure to that concept. And what's kind of funny to me is I have a lot of traders who tell me how many times they go through various modules. Very few come back and say, hey, I went through the money management module and I really picked up some powerful stuff there. I got to keep that at top of mind awareness. Why? Because it's not what they think trading's about. It's all about technicals. Show me how that indicator looks again. Show me when I can do, 2 pips this, where's the close, blah, blah. It's all technical. And yet, not just myself, but every educator out there, whether they're good educators or not, are always giving you, hey, trading is only about 10 to 15% technical. The rest of it is all mental. It's all the head game. So 85, 95% of the game, I'm trying to write that as one letter, 85 to 90% of the game is all mental. And yet, where do traders spend 85 to 95% of their time? On the technical stuff. Well, here's what very few people, very few traders passed right over. Watch the heat. Yeah. Here's what very few traders didn't understand. These guys that put 5%, 10% to their trade that blew through that 29,000, hey, it's cool if they've got big money behind that. But for the average trader, if you want to be here tomorrow, you can't dust your account today. The way you remain a player in the Forex is to be able to be here tomorrow. And for the most part, what that means is capital. And the way you be here tomorrow is not throw it away today. You've got to have the discipline to overcome the temptation for the quick riches, because with the quick riches come the quick losses. Usually lockstep together, right? And so what the traders miss with the entire system, the entire new paradigm thinking, the entire Shredder FX system, is conserve and protect is not just about money. It's about your head game. Most everybody in here has children or has had raised children. Some of you haven't, but some of you are about to. Looking at a few of the names. But there's just certain generalities of a thing a parent does, right? You don't let your 5-year-old watch triple X movies on cable. You don't want your 10-year-old hanging around a bunch of sailors on leave with foul language. If you're out in a group somewhere and foul talk starts coming up, if you can manage to talk to somebody that's starting it and just, hey, we got kids around and they don't pay attention, what do? You take your kid out of that area. You move them. You are protecting their mental game. You are protecting how their brain is being formed and how they're going to see the world. And yet, so few traders are willing to do that for themselves. So what we have in Shredder, as much as it was possible to be done, and it starts with the 310 system, is to have a trading environment where the head game is protected. Because like money, the way you get to be here tomorrow and trade is if you can be here tomorrow. If your head game takes you out, you can't be here tomorrow. So you not only need money to be a player, you need the right head game to be a player. And if that head game gets out of whack, it doesn't matter how much money you have. So conserve and protect is about as much as your head game as it is the money end of things. Very significant to your money management, very significant to your viability to be a trader tomorrow. So there's things inherent in Shredder to work on that, to make it better than the other environment. We've got an old paradigm trader with a 100 pip stop loss. He gets stopped out. He's got 2% in that 100 pip stop loss. He gets stopped out. What's the impact? He's minus 2%. What about a Shredder trader? 2% to a 10 pip stop loss. He gets stopped out. What's the impact? 2% out of his account. To the financial accountant reviewing these two traders and their assets, they're both down 2%. That's how he's going to see it, or she's going to see it. The reality is there's a head game component that the financial analyst doesn't see. And that head game component for the trader in the old paradigm who lost 2%, whose mind focuses more on the fact that it's 100 pips, he's thinking, oh my God, it's going to take a 100 pip gain just to get back to break even. the 2% loser on a shredder trade is down 10 pips, still 2% of his count. But by comparison, he's much better off because he only has to gain 10 pips to get back to break even. And then we get into the real world implications of all that. You know, how many 100 pip day opportunities are there versus how many 10 pip a day opportunities, blah, 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 blah. But the bottom line is, between the two who are using realistic and conservative risk in their trades, 2%, one is still has a much stronger head game potential than the other. So that's just one simple way that the 310, you know, I said last week, it's all done for you. It's all done via that 310. There's protection that you're not afforded in the other trading environment that is out there. The 50 pip stop loss, the 100 pip stop loss, the 148.2 pip stop loss in those scans I posted. Those traders have a much more challenging fight. And so on goes the head game protection and the head game evolution inside Shredder, as long as you trade it properly. What has to be in alignment with the protection, the conservation, the protection of the head game inside Shredder and harmonic wave convergence is your self-awareness, your understanding that ego goes hand in hand with that. So if your ego is so strong that it's not going to allow the things that should conserve and protect your head game inside a Shredder, then your head game isn't going to be conserved and protected. And you're going to have a lot of inconsistent trading. So the head game, and we all know it, we've all heard it 1,000 times. Traders have different degree of belief in that it really is that big of a factor. And their ego is always amazing them, but they never acknowledge it. I could put up stuff on the blackboard here and say, all right, any questions? Everybody get this? Is everybody with me? Common thing I say, is everybody with me? Yes, 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 yes. Come on, guys, this is the time. If you don't get it, let me know. Yes, 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 yes. We're good, we're good, we're good. And then I look at trades the next day, and they reflect the exact opposite. There was no understanding of what I taught. And so we're presented with the reality of, intellectually, academically, I understood this. Now when I come to the charts, there's emotion involved. You don't want to admit that the ego part was the one that was too quick to say, I understand this. And now it's come time to put it to practice, and you struggle with consistency because your ego was lying to you to begin with when you said you understood it. Understood it with thoroughness so you can go to the chart and make it happen when you go to the chart. So all right, help me out. Was it Clint Eastwood or Kenny Rogers? Who's the, a man's got to know his limitations? That's Dirty Harry, right? I can almost hear Clint Eastwood, kind of, a man's got to know his limitations. I can almost hear him whispering it. I know my limitations. I know what gets me bored. I know what gets me frustrated. Even with the knowledge of the numbers, I don't like being in a slump. I'm working on it. I'm meditating on it. But you know what? I recognize it's there. So just like I talked before about injuring my knee and the prednisone giving me a tremendous, pinch, a tremendous, whatever you want to say, boost in putting on extra pounds while I'm on those steroids, the way to avoid putting on the pounds is not having the crap in the house that'll put the pounds on. So fine, I'm just a complete vulnerable idiot when it comes to taking prednisone. That doesn't mean you have to suffer the consequence. Find another way around it. Don't let prednisone take effect. Don't let it do its thing by having the crap in the house that you'll eat because you got the prednisone, right? So you've got to recognize where you're strong and weak and focus on that. So while I know, because I have a history of trading to show me, that -3s are just a gateway to what's on the other side, it doesn't mean if by Wednesday, if I have 6 of them in my account that in 2 days, that I'm a real happy guy. I'm human. I'm a trader, but I'm human. So I've learned that my style of trading can control the degree of emotion and head game I have going on inside a particular week or month or trade. And so if I understand what causes it, just because I'm too weak to affect it, but if I'm understanding what causes it, I just change it. Dude, you're on prednisone. If there are chips in the house, you're going to eat them. Don't try and fight the prednisone. Just don't buy the chips. You know, we posted that link, and then Tim Phillips put up another one. 2 traders, you know, in Sykes, you know, $1 Million Challenge program. And that first one that I put up, the kid was what, 21, and you know, he turned 22 in that year. Started with $27,000, so it's not like he was exactly, you know, $500 account, but that's not the point. He started with $27,000, and in 9 months he had it. It was just under $1 million, 980,000 or whatever it was in 9 months. And when Sykes was asking him, you know, how'd you get there? How'd you get there? One of the top things he said was selectivity. I looked at what was working for me and what wasn't working for me, and I stopped doing the stuff that wasn't working for me, and I did more of the stuff that was working for me. And you have to sit back sometimes, you know, as a coach, I sit back and sometimes I just shake my head. Why do I see traders bucking the system for things that are iffy? It doesn't mean that statistically, if they push through hundreds of those iffy moves, they can't statistically make it very profitable. But I'm only talking the money side there, and I got to tell you guys, as a coach, as a transparent trader, the stuff that happens, you know, on paper and spreadsheets, you know, financially is not the biggest part of the game. It's the head game. So while I know if they take the volume of trades and they approach each of those trades at the same time, they're going to end up with good money. The trouble is, do they have the understanding? Do they have the discipline to stay with it? So the volume of trades will balance it out for them. So I'm not that strong. See, I'm going to tell you, got a flaw there. There are elements of trading that either I don't like doing, or, you know, in pressure moments, because I got so much going on during the day that I just put pressure on myself for my trades to work. I've said this before, and hopefully you understand this from this conversation I'm just having and about selectivity. I'm not saying this from a point of arrogance, but I only take trades I know I'm going to win. Does that make sense now when I say that? I only take trades I know I'm going to win. Does it mean I couldn't make more money if I took some of these other trades? Absolutely. There'd be some months I could probably make a lot more money. But my head game wouldn't be as strong month to month to month to month to month. My confidence wouldn't be as strong month to month to month to month. So you have to look at your history. You have to look at your individual trading record and say, what am I doing? You know, talked way back in SFX 30, talked way back, you know, to the hecklers when I was doing open webinars, you know, 10, 11 years ago, marketing webinars. Oh, you know, will you guarantee me your system will work? And I'm like, hell no. You know, you're trying to put me on the spot? You think I'm going to be stupid enough to say yes? Hell no, I won't guarantee it. Why? And then I go through the minefield example. You have one objective, get to the other side of the minefield. You had somebody walking right in front of you, goes from where you are to the other side of the minefield. Now it's your turn. And 25% of the people follow right in those footsteps. You know, 25, 30, sometimes as much as 50%. Usually not quite that high. Another 25% will follow you about a third of the way, halfway, and then they start meandering out of the footsteps. And then right from the very first step, you got another 25%. Just going to go this way, man, go that way. They're not even looking at the steps in front of them. With one objective, get to the other side. I don't understand in that analysis, get to the other side, with the objective of that and the analysis of that objective, just to get to the other side, why people go outside those footsteps. Well, I do understand it. I don't comprehend it. I understand it. It's called ego at some level. But from a practicality, from a logic standpoint, it makes no sense. The objective never was, who can be the first one to get to the other side without blowing themselves up walking outside of the footsteps. That was never the stated objective. And yet, this is how a lot of people go with their trading. I can say, don't do this, don't do this, don't do this, don't do this, and I look at trades and they're posting it, and they did it. Well, I thought, well, I was expecting, well, it should have. And it's, you know, it goes back to the story I told you about my granddaddy, and a lot of people have heard that, you know, wedding day stuff about, do you want to be happy or do you want to be right? And we got a lot of traders that want to be right. That's ego. They get their fulfillment from their ego trying to prove itself right. But that's a compensation mechanism because their results aren't there. So they have to get satisfaction. They have to get a sense of fulfillment from something. And so it's in deviation. It's in going outside the bell curve and playing the odds there. And the thing is, you can go outside that bell curve sometimes. And with our system, the way it's been built and designed, you can actually go outside that bell curve quite a bit. And as long as you do it with volume and consistently, you're still going to be okay. You're going to make it across that minefield more times in one piece than you'll get blown up. But the trouble is, or maybe not even blown up, just, you know, lose an arm, lose a leg, whatever. But getting to the other side 7 times out of 10, was it worth it the 3 times, you know, you lost your foot, you lost your arm, etc.? So you can still win. You can still win with percentages. But the head game part of it, guys, conserve and protect. You don't want to operate in conflict. You don't want to trade in conflict. You don't want to sit there and be the super good parent, denying exposure to bad stuff in your children's eyes. Now, again, we don't want to over-baby our children. You know, I want them to be 19 years old and you're still babying them. But you know what I'm talking about. We have certain things we protect our children from. And in fact, it's such an innate, strong DNA push. When we see a parent that does violate that with their own children, it totally upsets us. How could their parent do that? How could their mom and dad let them do that? How can they act that way? How can they sit there and let them, you know, do what they're doing? It's a strong feeling. It's a strong urge to protect that child's mental condition, what they're exposed to. But you won't do it to yourself. So, with TAB29, there are various ways of trading it. And with volume, things will be there. Now, the other thing traders make mistakes with, just being honest in what I see in observation over the years, the majority of traders will look at a trade or one or two trades, and they'll try and project that for the other 98 out of 100 trades. Well, they said this is the thing I should be trying to do, and I did it twice and it didn't work. So let me go do something else. So for me, with TAB29, I like trend lines, I like pitchforks, because it increases the probability. It brings extra confirmation. So what I'm saying is this: if I have a trading opportunity, let's say I have my peak 3 indicator field, and we're talking a 1-minute chart, so this is my 1-minute peak 3, and I have a nice move up, and my 10-minute wave was there. And again, we know we don't have to have the lower level leading upper level considerations. I don't have to draw this like this perfect convergence like I used to have to draw for multi-wave. But what we know about peak 3 is when we see that physical hook back, and we see this thing pulling back, when we look down at our trend bars, and we got a whole bunch of them turning red. Well, there's only 6 of them, so. And when we look at that, we see them turning red. And we get this within 2 or 3 pips. For the most part, assuming everything is right, we have a channel that's of acceptable width, nothing else weird going on, no trick question here. Is this not normally a good trade entry? The answer is yes, it is. But would I take that trade? Yes, I would. So let's remember what I just said. Is that, draw a duplicate, is that a trade we would want to take in peak 3? So we have a 10-minute, so we're actually taking a 10-minute trade from a technical perspective. We get our hook back, it's within 2 to 3 pips. We have a 5-pip price channel. You know, everything else is nice. So there's no trick. I'm not saying, oh, what about this and what about that? No trick question involved. I just want to get down to this trade entry. See, if this is a trade entry and I would take it, then the question is, what difference is that than this trade, where that is a trend line, where that is the 38.2 Fibonacci retracement of a bigger move down. What's the difference between those two? If I'm going to take this trade right here, what does this do for this trade? Do I need this? Let me rephrase the question. Do I need that trend line to take this trade on the right? Trade 1, trade 2. Do I need the trend line to take this trade? Now the question is, why would I take trade number 2? Well, because I looked at it and I said, you know, realistically, based on everything I see, I stand at least a 50-50 chance of winning this trade. And based on its projected path down to whatever, another trend line, convergence, support, you know, whatever, I see, you know, a potential for 21 pips. So I got a 50-50 shot with a 7-to-1 reward to risk ratio. That is a trade each one of us should take 7 days a week. So that's an acceptable trade to take. What's the difference between that and this trade over here? It's the exact same setup. The indicators are doing exactly the same thing. It's the same number of pips up. It's, you know, everything's the same. The difference is this one has the trend line touch. It'll be recorded. It'll be posted. The difference is, does the distance for this risk-reward analysis change any? Absolutely not. It's still potentially 21 pips down. It's still 7-to-1 against a 3-pip stop loss. The difference is, if this trend line had bounced price, you know, I'm going to erase my 38% line now, but I'm just, stay with me because I'm just trying to make this all one piece here. If this, the history here shows us all these nice scouter wicks bouncing off this thing. If I get this bounce here, my odds, instead of just being 50-50, probably climb to 80-20. Maybe 70-30, whatever. There's a distinct advantage here compared to this. Now, I just said at 7-to-1 with the 50-50 odds, what does that mean? We go back to the coin toss. Remember what 50-50 means. This means if you and I were Zoe, I'll bring Zoe in. Zoe and I had this bet last time, or it was Tim Phillips, one of you two. You know, what it means is Zoe and I are going to make a bet. I'm going to say when I flip the coin and it ends up heads, I will pay you $1. And if I flip the coin and it ends up tails, you pay me $7. That's what 7-to-1 is at 50-50. And the question I asked was, how many times do you want me to flip this coin? Doesn't matter who wins 5 times in a row or whatever. The thing is, I know over time, you know, 100 flips, 500 flips, by the time, the more we go up, the exact closer it gets out to multiple decimal places, this is going to be a 50-50 proposition. And so what determines the profitability here is the risk to reward, or reward to risk. Over time, this will be just great. So if I can elevate, not falsely, but if I could justify that my probability is at least a 50-50, and I should be able to do that most of the time with what we're doing. If I have good positive reward to risk, we should take this trade. But we have to take it every time. We can't lose twice and then stop taking these. We have to take it every time, because that's how it pans out. Just like flipping this coin with Zoe. Suppose I flipped heads 5 times in a row. I owe Zoe $5. I can't quit the game because I just flipped 5 times in a row in a 50-50 proposition. I've got to continue flipping. We'll eventually get to 50-50, and when we do, it'll be 7-to-1 in my favor. So what is the difference between 50-50 and 80-20? It's the same trade. This is a qualifiable trade per the system. What it means is I'm going to win over here 30% more of the time. That's what it means. And so So there's times where patience is very appropriate. I will wait for the setup with the trend lines, to the pip touches. Because the probability in those goes way, way, way up. And if I hold out for them and I'm making 30% more in them, the compounding that takes place, the head game preservation that takes place because my win percentage is really high. Remember, I don't like taking trades unless I know in advance I'm going to win them. No, I don't hold that true for every trade. If I have a trade opportunity, it's 50-50 and it's 200 to 1 reward to risk, I'm taking that trade. The vast majority of you don't buy big ticket lottery tickets, I imagine. But the time the lottery gets up to $350 million, if it was a heads or tails toss, would you spend $5 on a lottery ticket? I bet you would. The reason you don't buy them is because it's 1 in 350. You know, it's 350 million to 1 odds. So it's throwing money away. Yeah, somebody's going to win, but it ain't going to be you. 2 people, one of them is going to be a winner. I'll buy that ticket, and I'll probably pay more than $5 for it, right? Wouldn't you? $350 million, you stand a 50% chance of getting it? Trouble is, we never get those odds. But if we did, we'd take it. So, yes, I do say for the most part, I only take trades I know I'm going to win. There are a few exceptions to that. Don't want to be like not transparent. Does that mean that this trade over here isn't a good trade? Absolutely not. It just means for me, in the amount of time I have to actually be on the charts, and the sporadic nature of the amount of time I have to be on the charts, which varies, not only is it sporadic throughout the day, it varies day to day, which of those times I get to be on the charts. So for my style trading, in order to protect my head game, so every time I go to the charts, I only trade if I'm going to win, I like taking trades that I win. Now, I'll differ that than somebody that can plant themselves in a seat for 4 hours every night. That's a different person. That person may not want to wait for, see, I can set traps for these and take them just when they come along. I might have a day I don't have any trades. It's okay. Somebody else might plot themselves in their seat for 4 hours because they can or they want to. Fits their objectives right now and their capabilities, their responsibilities. They don't want to wait for these, and that's perfectly okay. This is a great trade to take. So we can't have a trader come here and get confused. Well, I'm confused. Do I need trend lines to make this thing work? Well, no, you don't. It's just the trades that you take with them will have a higher percentage of winning in each individual trade, which then gets compounded over time. So now we also have challenges in that traders kind of understand that. So traders have absorbed a little bit of what I've been saying about that, but now they're drawing pitchforks and they're trying to, or trend lines, they're trying to force the trend lines to fit. Some of that is truly understanding that it doesn't fit and they're trying to make it anyway. And some of it is just a lack of understanding about channels and trend lines. So a lot of what we've seen so far today is the head game and, you know, the bigger picture, philosophy, you know, strategy. Let's look at some technicals, because that's why y'all are here anyway. Who are you kidding? I want to look at a couple of trades that were trader submitted, just to bring some understanding. So we'll look at this trade by Isaac. So Isaac, thank you for posting the trade in a very transparent way, asking for insight. And there's a lot of things to cover here, but let's just look at a few. So in a general sense, let me go back here. This is what I do when I go to the charts. This is how I go through my qualification. I'm not saying this is what everybody has to do. I'm not saying this is the system. This just says this is how I see the system and how I want to personalize it for me and my understanding, drilling it down to that point where I say, yes, it's time for me to take this trade because I know I'm going to win it. So if we think of 3 charts on our computer, and we know what they are as per Shredder setup. We have our 30-minute chart and our 10-minute chart and our 1-minute chart. The process that I go through is this, and it's pretty simple. Yeah, I'll just keep it green. On a 30-minute chart, I'm going to be looking at my peak 3 colored blue, not peak 330, but peak 3 colored blue in a pro chart world. And I'm going to be looking for whatever resembles highs and lows in the moves. Now, sometimes it's not going to be all up. Sometimes it's not going to be all the way down. But essentially, you know, peak 3 is telling us those are the times the trade has gone to the top and bottom. And it doesn't matter what it looks like up here at the moment. I don't spend my time up here first. I spend my time in the indicator channel, if on a 30-minute chart, looking at the 30-minute peak 3. And I note the best I can, and I will physically get here with ink to go and draw red dots on it. Some of you who are private coached have seen me do this. And then I go to the price field and I say, put red dots on those price points. There was a high up here somewhere, there was a low, there was a high, there was a low, there was a high, there was a low, and there was a high. And all of a sudden, I might not have seen it with my naked eyes, but maybe I did. I can see a trend line. I can see a channel. And sometimes it's not the channel that you think you see. This is why this exercise, I always start here, noting where the highs and lows are, and then duplicating those dots up in price up above, and then connecting the lines on the dots up above. Then I go to my 10-minute chart, and I do the same thing. Now, sometimes we have the chart zoomed in for trading purposes, and I can't do this. So if I can't, then I zoom it out. I want to get enough in my current history, and look, what happens if I can't do this? It disqualifies my trade for the most part. I don't care how everything else. I never got down to looking at my TAB29 on my 1-minute chart. Do y'all see that? Did you see where I started? Did I start by looking at my TAB29 indicator on my chart? Oh, look at this crap, man. I got a beautiful convergence here. I better take the trade. I did not start there. I started way over on the 30-minute chart. And I identified, if I could, the 30-minute channel. And then I come to my 10-minute chart and I do the exact same thing. Now, you know what? It's not going to be like the 30-minute channel, is it? Just because those are the tops and bottoms, it doesn't mean that it can't look like this in terms of trend lines. in terms of the resulting channel, oh my Lord, Steve. Should have done that one in blue to begin with. I try and stay with the channel lines with color markers here, at least for training purpose, so we kind of understand what I'm talking about. All right. But when I went up here in price, I found, well, here was the 10-minute top that generated this top, and here was the 10-minute bottom, and it boom, 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 boom. So I'm drawing the dots, and then after I draw the dots, I go, holy smokes, look at the channel. Now again, sometimes it's very obvious, sometimes it's not. And you know what? I then say, can I find that channel in my 30-minute price movement? Do I see some point where this 30-minute move, did that? And sure enough, I will. It's what took it from the last 30-minute convergence, which was down here, to the 30-minute convergence, which is up here. And this entire channel now plugs nicely into my 30-minute chart. Might be steeper, because it's a 30-minute. Maybe it's not because of the way I drew this out. But what ends up happening then, that being, I can see my 10-minute channel on my 30-minute move. It took the 30-minute wave from its previous low, and that 30-minute wave went what? It cycled up. And I could see that channel very distinctly. And here it is on my 10-minute chart. And then I look at my 1-minute chart, and what do I want to see on my 1-minute chart? I better see something that looks like this. Doesn't have to be steep. It's going to get stretched out. And guess what? How did I draw those lines? Because I went down to my 1 minute, I found my peak 3. That was doing its thing. And I came down here and I drew red dots. Getting tired of the red dots yet? I drew my red dots. And I went up here and I drew them. And I found a channel. And I can see, depending on how I have zoomed out in my 10-minute, if I zoomed in now to my 10-minute, and I'm only going to put, let's say, that much of my 10-minute move on the chart, I will see my 1-minute channel on my 10-minute chart. And now I understand the waveology. When my 10-minute wave gets to the top here, we're not interested in this 1-minute wave and this 1-minute wave and this 1-minute wave and this 1-minute wave. We're only interested in the 1-minute wave top that is also the same top with the 10-minute. Because that point right here, this point right here in price, represents this point right here, where the 1-minute wave meets the 10 at the top. And that point right there represents the 30-minute wave, where the 10-minute channel here got to the top of the 30-minute channel. So I want to understand what the channels are. Why do I need to understand what the channels are? There's one quick answer. Why do I need to understand what the channels are? I'll wait to get the right answer. Hopefully I don't have to wait too long. Tell me more. Yes, Peter, exactly. How do you do reward to risk if you don't know where the other side of the channel is? For the most part. Now you might have a big ass 4-hour Fibonacci, excuse my language. You might have a big 4-hour strong 38.2%, and I don't need a channel to know where it's going. That's just, you know, I'm gunning for that. That's fair. But most of the time with channels and trend lines, your risk is based on the traverse of that channel. So let me ask you something. In order to take this 10-minute trade, and let's just draw it out as I've had it drawn, here comes my 30. So here's the question. My 1-minute channel here, from top to bottom, is 7 pips. Can I take this 30-minute trade? More than 2 need to answer. See, what happens with this? Let's just stay at the 1 minute. So here was price movement on my 1-minute chart, and it got to this top, and this identified it as the same as the top of the 10-minute chart. So here is that 1-minute channel. What has to happen, this is what you have to understand at this point in time. At the time this is converging with my 10-minute wave, this 1-minute channel is no longer a consideration. Why? Because at the very top here, if it was just a 10-minute channel, now listen to my condition, if it was just a 10-minute channel and it was going to continue onward, at the very top here, my 1-minute channel is reversing. What's going to happen now is my 1-minute channel is going to have a down move. And therefore I don't have a bottom on it anymore. The bottom is evaporated. Once I get, in other words, once I get here in price movement, that bottom goes away because I'm at the very top of not just the 1 minute but the 10-minute, i.e. here's my 10-minute channel. My 1-minute channel is intersecting it. What's going to happen is, that's being the top, my 1-minute channel now reverses, and we assume price is going to head back down. I.e. this line is no longer here, guys. From this point here, we'll have an impulsive move out of there. Price can come and just go like this now. We didn't trade the 1-minute channel here. We're trading the 10-minute channel, which might be 15 pips wide. But it wasn't just the 10-minute channel. It was also the 30-minute channel. So I would, at a 10-minute trade, my attention has to leave the 1-minute channel and go to the 10-minute channel. How wide is the 10-minute channel? Because why? I'm at the top of the 10-minute channel. If that's the top of the 10-minute channel, maybe the bottom of the 10-minute channel is down here. So I'm no longer trading the moves inside my 1-minute channel. At this point in time, I don't have that bottom boundary anymore. Now I'm going to go down. So if I get in the trade here, I'm in a 10-minute sell. And just like I'm at the top of that indicator channel, where's my 10-minute wave goal from the top? To go all the way down to the bottom. It's going to come down from the top here. It's going to come down to the bottom. So if that's a 20 pip channel, even if the 1 minute channel is 7 pips wide, this trade right here as a 10-minute trade is okay to take. The only time the limitation of 7 pips for the 1 minute channel is not a good time to trade is what? When I'm trying to take these trades. Now we have double teaching. Because Steve said, look at this indicator, and let's be sure if we're going to take a trade here, we're trading the impulsive side, not the corrective side, which means if this is harmonic wave convergence at the bottom and we're heading up, these are the impulsive moves, and these are the corrective moves. So the thing to trade here is not trade the corrections. They're going to be too short inside that 7 pip channel, and I want to trade the impulsive side. The problem is these are all 1 minute trades, except this one here. All the rest of these are 1 minute trades. I'm going from top of the 1 minute channel to the bottom, from the top to the bottom. 7 pips is not enough to play. So even though this indicator will tell us I want to take the impulsive side of this 10-minute move, unless the 1 minute channel is 12, 15, I say minimum 10, but again, you've heard me say many times, I'd like it to be closer to 15 for me. Unless it's that big, there are no trades here, impulsive or not. So this is where only trading the indicator will get you in problems. Because this is the final place you look to take the trade, not the first. A lot of you are getting in trouble because you make this the first place you look to take the trade. And therefore you get so RAS'd in favor of the trade, you forget about scale, and then it doesn't work for you. Or you ignore waveology, i.e. meaning I don't need to worry about this anymore if this is a 7 pip channel and I'm taking this 10-minute trade. All I need to worry about at 7 pips is I'm not taking these pieces of 10-minute trades because there's not enough to go across the channel. Well, it just so happens the very top of this trade, we also have, we had our 10-minute channel angling up some. Of course, it gets flattened out a little on our 1-minute chart. But the very top of that, we also have a convergence with our 30-minute channel top. Which means what? It means the top of your 10-minute channel is no longer a consideration as a barrier from top to bottom. Because we're taking a 30-minute trade. What's going to happen at that 30-minute trade? Same thing we just saw with the 1 minute in the 10. This 10-minute channel is now going to reverse. And at the very top right here, when we start coming down, there is no longer a barrier at the bottom of that channel. The channel has reversed. We have open space to go. That's why we can take it, even if the 10-minute channel has had a pip restriction. 10-minute channels, been told, 8, let's say it's 8 pips. So that would prevent us from trading these tops and bottoms because these are the tops and bottoms up and down inside that 10-minute channel. This very last top no longer has that restriction because it's also the 30-minute top. Which means this 10-minute channel will reverse. That line is no longer there as bottom of the channel. This one trade right here is good to take because it has open space to come down. So that looks like a lot of work to get down to a point where I could look at something like this and say, well, look, 110 blue. Trend bar is flipped in my direction. Take the trade, take the trade, take the trade. But you'll notice in that sequence of stuff, the very last thing I did was look right here and look at the trend bars. I did not come to the 1-minute chart and go right here and say, oh, I can take a trade. Doesn't matter if the 1-minute channel is only 7 pips wide. I'm not, those aren't scalping opportunities. Those are stop out opportunities. I didn't come here saying, oh, I'll just look at the 1-minute chart and take a trade with the 10-minute channel only being, 7, 8, 10 pips. Well, I'll wait for this convergence of the 10-minute level. Well, if the 10-minute channel is still just that, it's not going to be enough. The 10-minute channel has to be bigger if you're taking a 10-minute trade. It so happens this is a 30-minute trade. So the complete scope of the size of this move is not the size of the 1-minute channel. It's not the size of the 10-minute channel. It's the size of the 30-pip channel, the 30-minute channel. Because when I get up here, my 10-minute wave is now going to cycle my 30 down. What's that distance? That distance. The channel width only matters based on the time frame that you're trading. The only time I'm worried about the width of the 1-minute channel is if I'm trading 1-minute peaks. If I'm trading 10-minute peaks, the 1-minute channel doesn't mean as much as long as the 10-minute channel has its width. I can still be trading the 10-minute channel watching the 1-minute chart. Now I'm looking at power 10, but as power 10 cycles top to bottom, I got plenty of room. So I could take 10-minute trades. I might even be able to take, if this channel's big enough, I got a 20, 22, 25 pip channel in the 10-minute chart, I can take pieces of 10-minute trades, which are 1-minute trades. Because the scale's there in my favor. And if I'm taking a 30-minute trade like I'm showing here, the 1-minute channel size doesn't matter. The 10-minute channel size doesn't matter. All I need to make sure is my distance in my 30-minute channel is good enough. So this is how you move channels between time periods to rule in or rule out a trade. Now, guys, the whole concept of channel width and acceptable to trade, not acceptable to trade, are there exceptions to that? Meaning, when is that not relevant? I don't mean exception, but when is that not relevant? Even in the time period that you're trading. Yeah, Tim, I think I know what you mean. I mean, you're getting down to the detail. I want a bigger picture level of what I'm talking about. When don't I care about channel width? See, this whole conversation about channel width, what was I talking about? Only 50% of our trades. We have two kinds of trades. Harmonic wave convergence and fans are in peak 3 world, buys into the sells and sells into the buy. The whole concept of channel width only applies to harmonic wave convergence trades. Because as I've diagrammed plenty of times, the narrower the channel in a buy into the sell, sell into the buy, the better off we are, because it provides an environment where there's a smaller retrace, which means our stop loss can be moved and or we can stack trades. So I'm only talking about channel width here in terms of harmonic wave convergence. In most conversations, when we talk about channel width, we're talking about ranging or very, small sloped trends. because this channel is not the same width as this channel, even though they look it. That looks too wide. If you think I'm trying to catch on a technicality, I'm not. It's just my inability to draw. So try to make them closer. I.e., the distance from here to here is the same as the distance from here to here. For the most part, here, the distance up, if we're talking about going into a cell, and the distance down, coming into a retrace and or a buy, that is going to be the same distance as the correction, harmonic wave convergence being here. That is going to be about the same distance at this kind of correction, because at this point that's the direction, that's the way price moves. It's not going to measure the bottom and the top in that channel. So here we have bottom to top. Here we have top to bottom. Here we have top to bottom. Man. Ugh. Top to bottom. The difference in this particular one now is when we go bottom to top, because we have this impulsive move, it can go like that. Channel width is only talking about trades with harmonic wave convergence. I don't want the bronze traders trying to take this harmonic wave convergence trade, because it's going to be short-lived. One, this point here may slide a little to get to where it's going to stop, and then the retracement is so small. That's why you don't want either steepness. Well, let's talk first about channel width, actual physical channel width. You don't want channel width being narrow there, because, you know, in a harmonic wave convergence trade, the narrower the channel, the less this retracement can be. If we back this channel out, you know, so now it's this wide, look how deep that retracement comes. Price can come down, it can come down, it can come down, it can come down. Next thing you know, we have a 78.6% retracement. Here we're limited. When the channel's so tight, if this is the trade I take, I can barely get past 23.6, which means it's a very small pip move, which means there's not a lot of profitability in it. So we tell bronze traders, don't trade those small channels. We're talking about harmonic wave convergence. But it works the other way in our favor when we're doing buys into the sells, because it does shorten up this retracement, the insurance buy. We're going to take this harmonic wave convergence just as an insurance policy in case that is the channel breaker. I don't know what a harmonic wave convergence channel is, but no, they'll be the same. The harmonic wave convergence will appear in the channels. See, if I have a steep channel, now again, generally with steep channels, you're not going to have 100% price pullbacks in the waves. You know, I'm not going to get this nice top to bottom, top to bottom, top to bottom in the waves. There's so much pressure up that the pullback down, this is where you have a chance to draw trend lines inside the indicator field. There's such upward pressure that for the most part, not always, we're going to have our convergences at the top, and then we have our retracements, and then we have our convergences. And as this thing winds up to the ultimate upper level move, these tend to get shorter and shorter and shorter. But the upper level convergence is still going to be, you know, here are convergences in here, in here, and here. You're still going to find that was the convergence, that's the channel bottom. That's the convergence at the top, that's the channel bottom. That's the convergence at the top, that's the channel. And they're going to match up 100% with these moves. So there's not a, I mean, a price channel or harmonic wave convergence channel are one and the same as long as you're staying on the same time period. But back to the channel width question, you know, it depends on, first of all, we're only talking about harmonic wave convergence. We're talking about the dangers of narrow width to harmonic wave convergence because there's not enough room for a pullback. The steeper it goes, you know, if this is our original channel here, and we have a super tight channel here, that is in favor of us as well in terms of buys into the sells, because once again, what this does is it now narrows the wall of resistance for this thing to continue to come down, or support, but I'm talking about resistances in terms of support and resistance. It shortens that, so it can't, you know, it can't continue to pull back as a percentage of the original move. If the channel's this wide, oh gee, you know, we have a 50% retracement here. When the channel is this wide here, oh gee, you know, we can't even get to 38.6. We can't even get to 23. Because the combination of the steepness and the narrow of the channel shorten the distance this thing can move. So in one sense, the direction of this channel or the width of this channel would have two measurements. It was what is your typical correction going to make in that channel versus what is your typical impulsive move going to make in that channel. It doesn't really have to deal with an absolute value in width. I can't come over to a pip indicator, draw a stick, bring that stick over here and measure this. In terms of the impulsive side, it really is the verticality of that channel. That's all included in part 6 or part 5 and part 6 of the TAB29 training. In a move like this over here, the harmonic wave convergence trades, let me say this one more time with amplification, I don't take my first harmonic wave convergence trade in any kind of hyper run like this unless I have pips in hand. So somewhere along the line, somewhere down here, I did a buy into the sell. Now again, the channel has to establish itself, but somewhere down here there was a real opportune time to take a buy into the sell, and I got in it. And I rode that up to harmonic wave convergence. Yes, I take the harmonic wave convergence trade. It is my insurance policy against the channel breaker that is the reversal. But it's a -3 with, you know, 12 pips in hand. So there's no head game issues here. The bronze trader goes -3, the bronze trader goes -3, the bronze trader goes -3. They want to take their toys and go home. If the steepness of this angle is such, now again, you get into American versus foreign, you get into Americans with foreign accounts. The ideal thing here is to understand that the steeper this gets, I don't ever need to exit my buys into the sells. They will eventually take themselves out. As this price is moving up, I'm trailing it by 50%. It finally gets here. I have a 50% trailer. Where does that sit with the potentiality for this thing to come back and take it out? This price can't move backwards. Price won't be that steep. You're not going to have a 50% retracement. You're not going to have a 61.8 retracement with this kind of angle on the trend. There's too much upward pressure. It's fighting. Every pip it's coming down, it's fighting. It's fighting. It's trying to go down, but it can't. There's upward pressure. So this thing ends here. Now again, The steeper this gets, the better it gets. The narrower this gets, the more this opportunity for this to be short and short and short, which means the opportunity for it to take me out at 50 is gone. The opportunity for it to take me out at 60 is gone. So I just stay in this original buy down here. And I ride it up all the way to the top. At some point, price is going to reverse. And it's going to come down and go to my very last move from X to Y. That last move is going to have a 50% stop loss. And eventually all of these are going to come out. Down here, buy number 2. I don't need to take myself out here at harmonic wave convergence. I just let it ride. I take the harmonic wave convergence trade. Why? It's my insurance policy against that's the channel breaker and the reversal. Well, with live money, you have to overcome that. You just have to say, here's an opportunity to make money. We've had a big discussion on that too previously. We'll do it again. Part of money management and risk is saying, you know, because what happens in a trade like this, you can have 3 or 4 buys by the time you get to the top. You know, this could be a 50 pip trade that you make 130 pips on. And all you can do in terms of old paradigm US trader is catch, you know, well, here's the 15 in that one, and 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 you got your 50 or 60 pips. So when you see these repeatedly on the charts, you're going to start dreaming about what's 150 to 50. Why can I make 3 times the profit in that move? Or why should I be punished to make 1/3 the profit in that move? Because I'm a U.S. resident. So you start having to think about the strategies and why they're making sense. So as I explained before, what you have a lot of U.S. traders doing is opening overseas accounts. Yes, they include a little bit more risk, but if they're accelerating their profit by 3 times the speed, when that gets compounded on top of it, they can minimize their risk in that overseas account by every time they get to $10,000, they pull, you know, or every time they get to $15,000, they pull $10,000 out. It's called flipping an account. Versus the American trader that stays with their account and they don't have to pull anything out because they have more security because the NFA certification of that American broker. They're not guaranteed that, by the way. It's just additional comfort factor because the government says, well, they're supposedly keeping segregation of accounts. But as we've seen with some brokers, they lie on those certifications. So there's a way to overcome the risk in being overseas. And, you know, and look, don't let all the nightmares get you. There are plenty of legitimate overseas brokers that U.S. traders can open accounts in. But if I can make 3 times the profit, you're better off. Well, one can just sit down with a spreadsheet and do some math. And you can see whether you're better off flipping that account, and you flip it, meaning, you know, I'm going to get to 15 and pull out 10. You flip it like that for security reasons, for safety reasons. Because you don't want to be there $50,000, $75,000 account and have the broker close or take your money or whatever. The thing you're worried about with a foreign broker, not the thing you're so much focused on as a U.S. trader in a U.S. broker. But if I can make 3 times the profit, not because I'm putting 15% or 5% or 10% into a trade, but because I'm not limited with the, see, the thing with the brokers is stupid. This trade down here, once it gets up here, my very first trade, it gets up here and I got locked in 50%. So it moves 12 pips up and I got 6 pips locked in of profit. My account, I'm no longer risking my 2%. The 2% is cleared. I'm break even plus 6. My account, why does anybody need to protect me from losing that 2%? I can't lose it. I've already got it break even. However, until I totally close my trade, my margin is tied up. And the way the margin is so high with 50 to 1 leverage, I can't have but about 3.5% open risk in a trade. So I've used up 100% of my margin. So if my first trade is at 2%, I might be able to squeeze another 1.5, 1.4, 1 point, depends on which broker, what margin. I didn't say 15K was the number, I was just giving you an example. Some traders are going to pick less, some traders are going to pick more. Some traders are going to go back to just 1,000, some are going to leave 5,000. That's, you know. So I can't have, you know, here's my first trade. I can't even get in a second trade. Even though my first trade is cleared and I'm in profit, that margin is held until I close all of my trades. Or until I close that trade. So that margin doesn't get back to me until I close it. In fact, in the U.S., you can't even stay in the buy and enter the sell because that's hedging. Same pair, same account. They won't let you do that. You enter this sell as a protection mechanism. It automatically takes you out of your buy. So when the sell goes -3 on you, you've already shut out that buy. You know, you're already in this trade. I can't enter this buy because I'm already in a sell. If I enter this buy, it automatically closes my sell. Yeah, keeping us safe. Well, what they did was they looked at the dumbest, most uneducated trader, and they say, well, these guys need to be protected from losing money. Rather than saying, we need to cater to the trader who's educated himself. We need to cater to the trader who does understand this and knows what he's doing. But least common denominator, they're protecting the least common denominator. That's the way our society has become so politically correct. We protect the weakest and we punish the successful. I'm not saying you can't protect the weak, but don't punish the successful while you do it. You know, you got a bunch of drunk drivers in your county. The way you deal with it is how? You make stronger penalties for drunk driving. Mandatory sentences. Mandatory loss of license. You don't make happy hour illegal in your community as the way of cutting down drunk driving. But that's what we do. We punish the people who know how to behave in order to protect the people that can't, rather than letting the people who can't suffer the consequences and let the people who know how to behave advance themselves, whether that's responsible drinking or being a trader. In fact, the CFTC, I've said this again, you guys have been around a long time, you've heard me say this too many times, in the CFTC's defense of knocking out hedging, they start with the very premise in the opening sentence. Hedging, you know, essentially isn't a good thing because the trader's already in a losing position. They've defined what hedging is, but they've defined it incorrectly. Because as you know, we don't hedge until we're very pip positive. I'm 20 pips up, I'm 50 pips up, I'm 100 pips up in a buy. I hedge at the convergence at the top to minimize me from having to make the wrong choice. They're forcing us into choose head or choose tails. Rather than saying, no, I'm not sure which it is. I think I'm safer doing both. Because they already assume the suits that are appointed are not traders on that commission. And their opening premise was, since hedging is all about a trader already in a losing position, we don't want them to lose more, so we're gonna outrule hedging. There was no accommodation for, well, wait a second, what about the smart traders who are using this to protect themselves? Why don't you support that? It is stupid, Tim, but that's how it was done. So anyway, you know, as a U.S. trader, you have to figure these things. These are the most profitable moves in the market, and they're the highest percentage moves in the market. Once you have an established channel, these buys into the sells are not going to be beat anywhere else with the percentage and the strength and the ease and the speed of making pips. Will not be found anywhere else in trading. So, in summary, what does another one of Steve's massively business slides look like? It was about, how do I take a trade? What are you doing when you take a trade? Are you coming to the chart and saying, oh gee, what does this look like here? And then setting up a trade to fit that expectation, to fit that analysis? Or are you coming here and saying, what does it look like big picture? What do these waves look like? What's my 62 look like? What harmonic am I at? Where's this? What does this look like? And then, well, I kind of understand what's going on here. Let me see my 10-minute. Does the 10-minute fit back into that? Do I see how the 10-minute fits into that? And then when I can do that, oh, come down here. Does the 1 minute fit into this? And can I now see what's going on here? So when you do that, we reverse the cycle. We're not starting here and then going to everything else on the chart. We're starting here and then going to everything else, ending up in that 1 minute channel as long as things are clicking off the last, as we go along the way. This is indeed the same maneuver. It is the same entry requirement. It's just here, it's the final confirmation. It's not, Houston, we have a trade, because I looked at my 1 minute peak 3 indicator and it says I have a trade. So I don't want to be long-winded. We've already gone a long time, but I do want to talk just a second about this trade. So taking that approach, what does somebody want to tell me about what we see on this chart? Yeah, it's impulsive move. Don't forget what I just taught you. Don't forget what I just taught you. So look, let me repeat. I come to my 30-minute chart. Now remember what I said. Sometimes what we need to trade, the level we zoom into here, what we need to trade is not what we need to do to analyze. I don't know what this looks like. I'll just show you what I do. I put a dot at the top of the channel, and I put a dot at the bottom of the channel, and I put a dot at the top of the channel. I find those dots on the chart. And then I draw my trend lines. Guess what? With only the information I have here, my 30-minute channel looks like that. Because here I am at the top of the channel traversing down, and that's exactly what I can see in multi-wave. And I get to the bottom of the channel and I'm making my way up, and that's exactly what I can see in multi-wave. Now if that's my 30-minute channel, once again, should have drawn it in blue, but white really stands out when we're making channels. If that's my 30-minute channel, what do I see on my 10-minute chart? I can't really, we're zoomed in at a different level here. We're actually more zoomed in on the 30 than we are the 10. But isn't this the movement inside my 30-minute channel from top to bottom? Shouldn't my 10-minute wave be cycling me that? Isn't my 10-minute wave 1, 2, 3, 4, 5, right? It's cycling my 30-minute wave from top to bottom. My 30-minute wave top is there. My 30-minute wave bottom is there. So if that's my cycle down and that's my cycle up, is this a correct representation to think of any of this being a 10-minute channel? Do you see how that's a little incongruent? what does my 10-minute channel look like on my 30-minute chart? See, that helps me. Understanding the 30-minute channel helps me understand the 10-minute channel, because the 10-minute channel is going to cycle up and down the 30-minute channel. Here is one 10-minute channel. Here's another 10-minute channel. Can I find that on my 10-minute chart? Yeah. Here's my channel down, and here's my channel up. Those are your 10-minute channels, my friends. Does that make sense? Do you see how that works? Can you see these 10-minute channels on your 30-minute chart? Or vice versa? Can you see these 10-minute channels that are on your 30-minute chart in between, cycling down your 30-minute wave, cycling up your 30-minute wave? Can I find those over on my 10-minute chart? Yes, I can. So there was just an RAS, a mispremise, but of course then the RAS sticks with that. So the real opportunity I have here is within this 10-minute channel. Now again, not lots of data because it's very impulsive. So we have to, go more on wicks and such. And so you would try and draw a 10-minute channel in here the best you can. That looks like it. I've got a wick here. I've got a wick here. And I've got a wick here. And then what? You duplicate that line. You bring it to, in terms of the channel, my most, normally the lowest point, but in this case, the one that's sticking out the most. So maybe here. And you draw that up parallel and see if you get any touches. Now, by coincidence, you can see that this accelerated move of the 30-minute candle, does that look as impulsive when you put channel lines on it? Does that look absolutely as impulsive as it looks on the chart without the channels? Because guess what? Where was your bottom hit here? Somewhere down here was a buy into the sell. And look at the stretch of that impulsive move. Is this any different? It's just all occurred in one candle. So what you really have here down to the 1-minute chart, if I'm, and I know we can't connect that line there because it wasn't there, but I drew it down here. So in other words, before that big blue candle got up there, we already had a trend line coming like this. And we had a bottom to it, which was over here somewhere. I'm not real thrilled about taking cells in the middle of a channel. I want my cells to be at the top of the channel. Now it shows it as a convergence. But again, we don't want to start here. We want to end here. Which means I don't look here and say, oh, I have a trade. And then I force that trade. I want to come over here. What is my 30-minute wave doing? What are my 10-minute waves doing? Does this fit into what I see here? What's my 1-minute doing? Does this fit in here? If I can understand it all, and I have a trade top to bottom or bottom to top, I'll take that trade. Other than that, Steve doesn't trade. No, I don't know where these lines really belong on the 1-minute chart, so don't take my word for that. Again, I'm going to zoom out, get my lines on, and then zoom back in for trading purposes. I want to try and duplicate the lines I have on my 10-minute chart because they are precisely what is occurring on my 30-minute chart. So I want these to be matched up. It's hard to get a trend line on that because of the nature of the 3 candles, But I can put a trend line over here real well, and you see how it fits almost to the pip. Zoom this out a little, or zoom in a little, and this will become a little bigger, a bit fatter, a little better. You can get this right. Then I will zoom out my 1-minute chart and make sure I get this channel that seems to have good pip hits, good wick to the pip hits. I want to get that on my 1-minute chart because now I have a channel to trade. You know what? How many times have we seen this? Where we get to a point, it looks like it's the convergence. We get the signal that it's at the top. We did have a pretty impulsive move down, and then it turned right around and went all the way up. This is just like what? This is like a 30-minute wave convergence that's going to snake on us some. This just didn't snake. Just pulled back a little and then went to the higher high. By itself, yeah, if I didn't have anything else, I would take this trade. But when I see that when I see this convergence supposedly in the middle of the channel, that's just not a trade I take. That doesn't mean sometimes it's not the trade. It's just not in the scheme of 100 trades like this. It's not going to be the trade that gives me a lot of pips because I have a hard bottom. I want to take this trade. It's more realistic. And not only does this have a hard bottom, big enough channel to give me pips, it's good enough channel to get the pips. The problem is here, are you entering the trade here with your stop loss out here? Are you entering this trade with your stop loss here? See, one is recognizing where the channel really is, one isn't. If I'm not willing to take, if I don't want to expand my stop loss out that big, look at the size of these channels. If I don't want to extend my stop loss out that big, maybe this isn't a trade I want to take. Does the 310 help us understand channels? Yeah, it does. Stop loss should be at the end of this channel. Remember what I said about to the pip? So we have a stop loss line essentially outside this channel, right? Not 5 pips out like I've drawn it, but tighter in. And if I'm not willing to absorb that risk, it says something about, well, I guess I should pay attention to that trend line. This just doesn't match up. It doesn't mean this couldn't be a trade for 10 pips. It just doesn't. This isn't a trade that I would take time after time after time after time because my channel size isn't so big here. Now look, I'm not picking on Isaac. I appreciate the fact he drew this. He's doing Fibonacci work. He's trying to draw some channels. He found a good support resistance line here. And his resistance line was where he took the trade. So he had some justification for it. He had this little consolidation that was taking place that ended up giving him, a little bit of a support and resistance line. But that's, if it's the channel, what he failed to see then, where his mistake was, is he didn't see the channel changed. That doesn't necessarily negate this as a support and resistance line when he's out here, which is where he used it, but it does mean the channel has changed twice. This is a downward channel now, and this is an upward channel. Sometimes you have price moves out of a channel, and it really doesn't change the channel, but when I have a price move up, and I've got beautiful wick hits, scouter wicks like this coming up, and they all match up, and they all hit this line in the same spot. That, my friends, is a new channel. Oh, I see. I didn't see you here. You were scrolled into a higher spot in the attendance list, Isaac. I didn't know you were here. I'd still say the same thing because I know you watch this stuff, so I would still say the same thing. So this just isn't, for me, a high probability trade. It's mid-channel. And see, when you come along and you do something like that, you take a mid-channel trade and you would put the stop loss right here, that's forcing the 310. That's not a 310 as it naturally should work in our system. That's forcing a 310. What you want to say here is this is where I'm taking the trade, and this is my trend line for the top of the channel. I really have to protect that top of the channel. And if I don't like this distance because it's 15 pips, what do you do for a system where you have 2% to a 10 pip stop loss, and in order to take the trade and cover the channel, you have to exceed your calculated stop loss? I either got to come in here and adjust it, put 2% to a 15 pip stop loss, then I could put it on the outside of the channel. But now, what about my profitability? I'm making 2% every 15 pips instead of 2% every 10 pips. Doesn't sound like much, but... So it does depend on the channel width. Look, there's nothing wrong. If this is absolutely the top, remember the 1 minute channel doesn't count. If this is a 10-minute trade or a 30-minute trade, doesn't count as in determination of the width as long as I'm taking this as a 10-minute trade, which you were, which Isaac was. This wasn't just a 1 minute trade. So if the channel was small and let's say it was a 7-pip channel, and now he's only got to add a couple extra pips to cover the outside of the channel because he's taking it midstream. Because this isn't a 1 minute trade, it's a 10-minute trade, that's a different story. Because now just a couple extra pips I can cover where it might actually back up to. Then I'm just seeing myself, well, maybe I got in a little early. I saw this convergence. I didn't want to chance on it bolting out of here impulsively. So I'm going to go ahead and get in here. I'm only risking 2 extra pips. So my goal today was to bring some clarity on how you see the charts before you take your trade. And I just have a feeling I just created a lot of fog for about 50% of the traders. I hope not. I hope I brought a little clarity to it. So why is, I had somebody kind of ask me, well, I don't get it. I mean, trend lines are old school. And, you're marrying them up to your, tab system. And it seems like you're trying to drag the old paradigm into your system and not admit it and, blah, 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 blah. It's like, no. What have I always said about pitchforks? Why do I like pitchforks? Pitchforks are a standalone system in the new paradigm. They're the only other new paradigm system that I know of. Pitchforks are standalone. There are trading methodologies per Andrew on how to trade a pitchfork. There's money management inside a pitchfork. And I have a live trade with a 2 to 3 pip zone for entry where I can use a 310 stop loss. It's a real-time system. Which is why I say your trend lines have to be perfect. We can't have close. Remember, close only works in hand grenades and horseshoes. When trend lines are tight, they bring precise meaning to this turnaround. This turnaround confirmation then is very, very high probability and precise because the trend line itself is tight and precise if it's a proven trend line. But I can't have trend lines drawn where we're zigzagging all over the place. You can't make a trend line fit that doesn't fit. Well, you can, but that you're trying to justify a trade rather than trading. See, the accurate trend line there looks something like this. Now, I know this is a thicker trend line than our tool inside the charts here, so it does get a little distorted. But see, that's not an accurate, that's an accurate representation of that trend line. And unless this high had a really decent sized wick on it and it just retreated to here, this is not a trade per a trend line. On the other hand, I have traders that will draw the original trend line there and kind of make it fit. They scoop down into the top of this move here. As this thing's moving up, they start adjusting this thing to try and justify this trade. It looks like a trade, but see, that's fudging, and that's going to come back and bite you because the reality is that's the trend line. And this just missed it. It just wasn't a trade in this particular case. Too bad. It just wasn't a trade to take. I don't cry about it. I take the ones that are trades to take and go with that. Let the 80% work for you. Let it work its magic repeatedly in volumes of trades. All right. I've exhausted my voice. Hopefully I got something good here. I'm going to put this as a module. I'll kind of put an asterisk with it, but I'll put this up at the tab 29 as a part 7 addendum, because I think it gets into channels, the approach you take, and everything. Well, thanks, Isaac. Thank you for your trade post. You know, we got some younger guys in this group that have some things going for them. I'm not guaranteeing their success, but they have some things going for them. And one of those things is they've set their ego aside. You know, all these guys have posted trades in an inquisitive, I want to learn way. And that takes courage. That takes a little bit of understanding what ego is and setting aside, saying it's more important that I learn than, you know, people in this room going, ooh, whoa, wow. So thanks for the trade submission, Isaac, and letting us have this opportunity to use this as a learning example for everybody, because it's a good one. And I'll be honest, the first, 60 seconds I looked at the chart, your top trend line sucked me in. Before I looked at the entire chart, it sucked me in. And I said, well, the only thing he's done wrong is there should be a trend line down here. He needs an inclusive trend line. If there's some reason there was something down here, that's a different story. But with what I can see, that top trend line looks okay. This might be an inclusive trend line. And I'm looking all in the horizontal like you were, until I looked over here and I said, wait a second, these moves, you can't have the 30-minute chart make those moves without it being moved by the 10-minute wave. You can't have the 30-minute chart go from a top to a bottom to a new top by itself. It has to be cycled. So these are the 10-minute moves. And then you go find that over here, and this is your channel, not the horizontal stuff we have on there. Yeah, so that's why, look, don't be tempted. This is the seductive mistress down here. Okay? Don't be, don't be lured by that. Come in, as we come in the charts, ignore that. Start your journey over here. Figure out what's going on over here. Understand what's going on over here. Sometimes you have to marry up with this to figure it out, to even figure out what's going on over here. But once you figure out what's going on over here, this should tell the story of it, just in a smaller scale, a tighter scale. But the journey, the message should be the same. And then once I've got this, the last part of this move needs to be reflected in what I see on my 1-minute chart. Zoom it out until I see that. Zoom it out until I see that. I want to see this 1-minute channel from bottom to top so I can accurately draw these trend lines. And then I can zoom back in to operate. Once I've done that, I've checked off, I understand what's going on in the 30, I understand what's going on in the 10, I understand what's going on in the 1. Now I can come down here and say, well, what are the waves telling me about possibilities here? And now you have your potential trade. But if we start here, see, this channel is relative. It's going to tell you tops and bottoms, whether it's 3 pips or 30 pips. It's going to tell you tops and bottoms, whether that's a flat range or a 45-degree channel. Top is a top and a bottom is a bottom as far as this indicator is concerned. Yet all those things differ in how we're going to approach trading them. I'm not trying to muck it up and make it foggy and complex. It's just, it is what it is. All right. So if there are any questions on this that aren't in your head right now, just put them in the Facebook group. I will post this to the TAB29 page of videos. I will make a note in the PIP Club group. I will put the 17 key in it, and we'll go from there. So guys have a great rest of week. Have a great weekend. And as always, remember, life can be short. So for those people you care and love, let them know you care and love them, okay? Y'all have a great day.